Right now, the numbers look extraordinary. Crypto startups raised $11.2 billion in the first 6 months of 2026. But Dubai-based lawyer Irina Heaver and her team parsed every reported deal and found that not one disclosed dollar went to a truly permissionless, ungoverned project. Permissionless is the original crypto promise: no central gatekeeper, no company deciding who can join, no regulator approving what code can run. Today, that promise has been starved of mainstream capital. This is not a bear market, money is pouring in, but it is flowing exclusively to regulated, permissioned businesses. As of Sunday, the 16th of August 2026, the data is clear: Wall Street has rewritten crypto's rules, and the old cypherpunk era is being replaced by compliance-grade infrastructure. The shift did not happen overnight. After years of enforcement and uncertainty, institutional investors have drawn a bright line. If a token trades on a licensed venue with KYC checks and audited reserves, it can attract pension and sovereign capital. If it runs on an anonymous, permissionless protocol, it is legally radioactive. That is why BlackRock, Goldman Sachs, and Persian Gulf sovereign funds have moved so aggressively into the market in 2026. They are not betting on decentralization. They are betting on tokenized traditional assets, stablecoins, licensed custody, and compliance software. Irina Heaver's research suggests the money went into regulated businesses rather than open experiments. In plain terms, crypto is being rebuilt as a faster version of Wall Street, not a replacement for it. The impact is already visible. If you are a founder in August 2026, the pitch deck has changed. You lead with your license and your compliance officer, not your token. If you are a retail user, the products increasingly resemble brokerage accounts rather than wallets, with freeze functions, customer support, and identity checks. Permissionless DeFi protocols are not dead, but they are being cut off from growth capital. That means fewer new lending markets, fewer experimental automated market makers, and more centralized services. For developers, the opportunity has shifted towards private ledgers and regulated exchanges. For the ordinary holder, the trade-off is clearer oversight in exchange for less radical innovation. The capital is not just choosing one sector, it is changing what crypto itself means. Looking ahead, expect this pattern to harden. The second half of 2026 will likely bring even larger checks for regulated stablecoins, tokenized funds, and licensed custody, while unregulated protocols either seek licenses or migrate to smaller jurisdictions. The deeper risk is that permissionless innovation becomes a museum piece, just as the Internet's open protocols gave way to centralized platforms. If zero disclosed dollars went to permissionless projects in the first 6 months, the signal for founders is brutal. Institutional money now treats decentralization as a bug, not a feature. Some developers will push back, but they will need alternative funding models, such as community treasuries or offshore structures, to survive. The next few months will reveal whether regulatory clarity produces a healthier market or simply a more controlled one. The $11.2 billion raised in the first half of 2026 did not kill crypto. It redefined it. The permissionless era lost the one thing it needed to scale: institutional capital. What remains is a question: can an industry funded entirely by regulated money still invent the ungovernable? The answer will shape not just token prices, but the future of digital freedom itself.